A stock index is a number calculated to represent a particular section of the stock market. Usually it is seen as the leading measure representing the entire stock market. Very often we see one stock index associated with an exchange which represents the leading stocks trading on that exchange. Stock indices are widely quoted in the press and tracked by the public as they reflect the prevailing sentiment about the state of the economy. Stock indices are also often used as a benchmark for determining if a fund manager has added value by selecting stocks for a fund. A fund manager's return over the year can be compared to the return of a stock index over the same period to determine if the fund manager has generated greater return due to his stock selection strategies. Stock index is only one type of index from a number of indices that can be calculated using price of various stocks. For example, one can create an index from price of stocks of all banking companies to represent a banking index, or one may create a real estate index from price of stocks of real estate companies. Let's now look at how value of an index can be calculated. There are primarily two ways of calculating the value of an index. An index can be calculated by the price weighted method or the capitalization weighted method. In case of a price weighted index, the value of the index is calculated by adding the price of each stock and dividing the sum total by the number of stocks. So you essentially add prices of all the stocks that constitute the index and divide this sum by the number of stocks in the index. This implies that the stock with higher price has a greater influence on the value of the index compared to a stock with lower price. So for example, if stock A is trading at 10 and another stock B is trading at 10,000, and let's assume these are the only two stocks in the index, so the value of the index is 10 plus 10,000 and this sum divided by 2, so the value of index will be 5005. Now if only stock A were to move by 10% while stock B remains unchanged, new value of the index would be 11 plus 10,000 and dividing this sum by 2, so the new value of the index would be 5005.5. On the other hand, if stock A remains unchanged while the price of stock B moves by 10%, the new value of the index would be 5505. Since both the stocks are given equal weightage, the same percentage move in stock B may move the index more than the same percentage move in stock A. So the key drawback with price weighted index is that a stock with higher price may end up dominating the movement in the index, and hence such an index may not be truly representative of the section of the stock market from which it has been created. In order to avoid this, indexes are often calculated using capitalization weighted index. A capitalization weighted index is also known as the market weighted index. In case of capitalization weighted index, the market cap of the stock is used to determine the weightage attached to the stock prices, and hence a stock with greater market capitalization will have greater influence on the value of the index. So for the example we looked before, if stock A has 100,000 stocks outstanding while stock B has only 10 stocks issued, the market capitalization of stock A would be 1 million while that of stock B would be 100,000. We'll use each stock's market cap and divide it by the total market cap of the index constituents. So in this case, the total market cap would be 1.1 million. In order to arrive at the weightage to be given to each stock's price, we'll divide the stock market cap to the total market cap. Hence weightage for stock A would be 1 million divided by 1.1 million, which is equal to 10 by 11. On the other hand, the weightage for stock B would be 100,000 divided by 1.1 million, which is equal to 1 by 11. So here it is easy to see that the stock with the higher price cannot simply dominate the index just because of its higher price. This addresses the drawback of price weighted index, where a stock with higher price may end up dominating the movement in the index. Hence, capitalization weighted index are considered to be more representative of the section of the stock market from which they have been created.